Pickup in 2014 will be driven by advanced economies, while growth in emerging markets, although still strong, is expected to be weaker.
I think it's a case of good news and bad news. The good news in advanced economies, so in the US, private demand is strong. So unless there are fiscal accidents, then the recovery should continue. Japan is still doing well, and Europe, the good news is Europe seems to have started growth again. In emerging market economies, that's where the bad news is. And in many countries, growth has been lower than we expected and has declined quite a bit over the last 2 years.
Structural bottlenecks in infrastructure, labour markets and investment have also contributed to a slowdown in many emerging markets, while what happens in the world's largest economy remains crucial, particularly decisions on when the Federal Reserve will start tapering its asset purchases.
It's only going to happen if the US recovery becomes stronger and then the Fed feels that it has to increase interest rates. So from the point of view of the rest of the world, say emerging markets, there are two effects, right? US growth stronger, that's good, but higher interest rates, which are likely to lead to some capital outflows, less good. Some countries, the net effect, for most countries, the net effect will be positive, for some, maybe not. So I think that's what we're looking forward for the next few years.
Blanchard believes pulling the economy out of a protracted period of subdued economic performance will require advanced economies to address old challenges and for emerging and developing economies to steer through their economic transitions with credible policies.
For the periphery, a bit less optimistic. I'm not sure the corner has been turned, but it may be. There's some good news. On the export front, many of these countries are really increasing exports quite a bit. That's good news. But internal demand is still weak. And so it's a fight between the two. And at this stage, very low growth is still the forecast.
The report predicts growth rates of around 5% for the sub-Saharan region, up to 6% in 2014. South Africa is expected to grow at a modest 2% this year.
The report says growth in South Africa will improve when the global picture improves and infrastructure bottlenecks are alleviated, but cites weak investor and consumer confidence, continued tensions in industrial relations, policy uncertainty and elevated household debt as among the factors that will weigh on economic performance. Sherwin Bryceby's SABC News, New York.